Can you
Yes,
start?
yes, please.
Okay, yeah. Okay, now you have, see, you have the base, this is the basic understanding. Okay, subsequently we are going to do all the things on this foundation only. Okay, how the most important thing is how the IFRS will treat financial instruments, how it is going to be initially recognized, and subsequently how it is going to be measured. Okay, now, I don't think so. I will see. Okay, fine. No, we will. When we are doing, we'll do it with all that effectiveness. What they say, company issue 4% loan notes with a nominal value 20,000. The loan notes are issued at discount. How much? 2.5%. Yeah, there are so many new things are coming up. Okay, new things are coming up. They have issued at discount of 2.5 and the issue cost is incurred how much? 534. The loan will be repayable at premium after 5 years. Okay, the effective rate of interest is 7%. Now, tell me, think carefully, take your time, and what amount has to be recorded. How much you have to record? Take your time. Think. Any idea? They are asking only for year one. We are not doing for all the 5 years.
$20,000.
How much?
20,000.
Yes. Issue price is how much?
20,000.
Next. Anything else? We have to deduct the discount amount. How much is the discount? At the rate of 2.5%?
500.
500, good. We have to deduct issue cost also. How much issue cost?
534.
534. How much is the net amount we will get?
20,000 minus 1034.
How much? 18,000?
966.
966. Are you clear about this?
Yes.
Is that initial recognition? Is it right? See, IFRS don't say anything. IFRS says that follow the rules, that's all. Okay, how much is the debit? Debit will be bank 18,966. Credit will be how much?
$20,000.
Huh?
20,000.
20?
20,000.
And difference?
Difference will go to the bank charges.
Debit will be bank charges. Discount. Okay, don't write don't. It is there, no issue. No, don't write. Debit will be the discount. Okay, discount allowed. Okay, 500. Debit will be issue cost 534. Credit will be liability, loan notes. How much? 20,000. Are you clear about this? Is it okay?
Yes.
Next. They are asking only for 1 year. They are asking only
Yeah.
for 1 year. What will be the finance cost? They are asking only for the 1 year. Only for year 1. Opening balance, effective rate, interest paid, and the total. Opening balance is how much? Tell me.
20,000.
Uh.
No, sorry. It's it's
Initial.
18,966.
Huh?
Opening balance is 18,966.
Yes. Effective rate, what is the rate they have mentioned?
7%.
How much?
One 327.
Good. Next. Interest rate, how much? Interest rate, how much?
4%.
Good. What is the amount?
$758.
Sanjay sir, think smart.
Okay, sorry.
No,
It's 800.
Huh?
800.
Exactly. When you are paying interest, you have to pay on the nominal value. Okay, you have to pay on the what you promised, you have to pay. 20,000 times 4%, it comes to how much? 800. Okay, it comes to how much? 800. Are you clear about this?
Yes.
Total amount is how much? Total is how much? Closing balance? 18966 plus 1327 minus 800. Every analysis we are adding some new features. Every analysis,
Yes.
basically every case is a new learning point. Are you clear about this?
Yes.
Next.
But I have an inquiry here.
Tell me, sir.
I am showing with the value $20,000. So I'm gonna get $20,000, right?
Hmm.
Discounted for him.
Hmm.
So the 500 is from the value he is giving to me.
Hmm.
Is it right? So the initial amount and the cost incurred are recoverable with the amount, right?
Yes.
Okay, okay.
Because see, the liability face value is different. The liability bank value receipts are different. Okay.
Okay.
This is the net receipts.
Now, if we
Yeah.
now for the second year, if we gonna let's say to count for it,
Okay.
the effective rate will be 7
100%.
or 10 or 10.
No. 7%. How it will change? Once they say effective rate is 7%, it will be 7% only.
Okay.
Okay, it will be. Now, I will give you, I will have a discussion on this. See the things. You are paying interest 4%. How much you are having effective rate? 7%. How much is the difference here? Difference is 3%. Is it? Difference is 3%. And effective rate is 7%. How much the premium? They are saying premium is going to be how much? 10%.
10%.
Is it right? This 7%, okay? This 7%, is it? This 7% and this 3%, if you add on, it will give you what?
The premium.
Premium. Is it right?
Yes.
Fine. Are you clear about this? How we are going to talk about the bonds issued at various stages and how the bonds has to be initially recognized and subsequently measured. The second part, okay, the second part is regarding the preference shares, okay. If you take the preference shares, is it right? There are various different kinds of preference shares. There is a irredeemable preference shares, means we are contain no obligation to make any payment. Irredeemable, 5 years, it is like a loan, okay. It is like either a capital or dividends. Irredeemable. Irredeemable means what? It will be for a fixed time or it will be forever. Irredeemable means
Forever.
forever. If that is the case, you have to classify under the category of equity. If preference are redeemable or have a cumulative dividend, non-cumulative dividends, is it right? You will have all the characteristics will be there. Cumulative, non-cumulative. dividends. Is it right? Redeemable. Is it? Redeemable. Redeemable. Non-redeemable. Is it? If it is a redeemable, we are going to pay it off after the end of the life, then it is going to be classified as a financial liability. The key element is that where there is a obligation, the instruments will represent a liability. Where there is no obligation, equity shares, no obligation. Is it right? Equity shares, no obligations. Equity shares, we can put it, once it is sold, it is sold. There is no return back. Okay? That is the reason we cannot put it as a equity, as a liability. Okay? This is the key difference. Where there is an obligation, constructive obligation, you have to make contractual obligation, then it has to be a liability. If there is no contractual obligation, there is no liability as such. Is it? Some preference shares are irredeemable, in which they are classified as equity. Is it? They will classify as equity. Where a preference shares provide for mandatory redemption by the issuer, when the preference shares provide a mandatory compulsory redemption by the issuer for a fixed or determinable amount of fixed or determinable future date. Okay? They are very clear about this. Isn't it? They are talking about a fixed, the mandatory redemption by the issuer, redeem, okay, for a fixed or determinable amount at a fixed or a determinable future date. Is there some preference shares are irredeemable? Means irredeemables means you have to make a conditions when it is going to be, is there any condition attached to it, or gives the holder the right to require the issuer to redeem the share after a particular date for a fixed amount. Is it? These instruments meet the definition of a financial liability and is classified as such. Some preference shares are irredeemable. Okay, some preference shares are irredeemable. If those irredeemable shares, you have a straightforward condition that it is going to be identified as a equity. When the preference shares provide mandatory redemption, it will be redeemed by a issuer at a fixed amount, at a fixed date. Is it? At a fixed amount, at a fixed determinable date, then it is going to be classified as a financial liability. Is it? Then it is going to be classified as a financial liability. Are you clear about this? Is it okay? These conditions is for what? This condition is irredeemable. Sorry, these conditions are redeemable. If it is a redeemable, it is going to be called as a financial liability. Is it okay about this? See, don't get,
Yes.
I know where you are getting confusion. You are getting confusion at this stage. Separate it. Now you will have more clarity here. You separate it. Don't mix the things, okay? Don't mix the things. This is when it is, if it is irredeemable, we are going to identify it as an equity. If it is redeemable, is a redemption. Is a redemption by the issuer. Redeem the shares at a particular date, then it is going to be a financial liability. Otherwise, it will be an equity. Is it there? What happened? Your silence gives me an indication that concept is not clear.
Well, it's the thing is, for myself, I did understand this, but we have not seen this in our experience as a practical example for this.
Huh.
Others, yes, we have seen somewhere one way or the other. But this one is
Ve-
totally pure academic. That's why.
Very rarest of the rarest cases, preference shares. Very rarest of the rare. Nobody nowadays issue preference shares. Is it? You find hardly, if I remember, if I recollect my experience, my knowledge, this is what I am following keenly, maybe I have missed it. Somewhere in 2021, it has at a global level, they have issued the preference shares. Very few companies. Is it?
Okay.
Now you don't have, if you see all the balance sheets, all the financial statements, you will not find any preference share capital. 100%. I have a good experience of reviewing very few. That also it very rarest of the rarest cases. Every other entity in the world have equity shareholder capital only. That is the reason for communicating. It is there in the initially. They have made the things little bit more clear on this. Okay, definitely you will not find. Have you ever grilled on the things and you come back tomorrow? Which company have recently issued preference shares? Is it recently issued preference shares? Then you will have and preference shares also. What happens? Maybe convertible or redeemable or irredeemable. These are all, even in the books you will not find. Is that even you take the books which has been published for the last 5 to 10 years, last 10 years books, the importance, they will mention 100%, there is no doubt on that, but they will not give that much importance to this. Okay? Is it clear?
Yes, for us.
Okay, 1 minute. I have 1 minute. Just preference shares now. 1 second. 1 second.